bring in JPMorgan Chief U.S. Economist Michael Feroli. Feroli and Santoli. I'll start with you, Michael Feroli, which is, it's hard to imagine that we're having conversations about a recession when we're adding in a tight jobs market more than 400,000 jobs and an unemployment rate at 3.6%. So how do you square that?
So I think the recession, at least as I understand it, the recession narrative or discussion is really about perhaps next year, not about next quarter. I think most people recognize that the momentum in the economy right now is pretty favorable. As you mentioned, the jobs number looking very timely and looking very strong. But as we see these financial conditions tighten, many of what you just talked about, stocks down, rates up, dollar way up, over time, if this continues, then you set yourself up for a scenario where maybe, a few quarters down the line, recession becomes more of a possibility. But again, as I understand it, I don't think it's a near-term concern, at least not for me, but rather something as you look out to next year becomes a little more of a real possibility.
So what do you think this is all about? That big rally off the Fed and then the big sell-off off the Fed? Is it about concerns that the Fed's going to make a mistake or not get inflation under control, or what? Yeah,
the reaction seems a little bit sclerotic. I do think perhaps Powell maybe misspoke or was a little too firm in ruling out 75 basis points on Wednesday, and maybe some people read that as not being committed enough to the inflation fight. But I think that's a misreading. I think they'll do what they have to do. But there may have been, some words I suppose he would have chosen differently. But the reaction has been a bit odd. But I would say on net, the fact that rates are generally up and the dollar is up is probably the kind of reaction they want. I mean, eventually, they're not just doing this for the sake, for the fun of it. They actually want to tighten financial conditions and slow down the pace of spending growth in the economy.
Mike Santoli, I would have thought that maybe the market would have had a better reaction, certainly bonds and stocks, to the wage numbers, which came in below expectation and continue to show a little bit weaker month-to-month changes. How's the market interpreting the jobs number?
Yeah, I guess arguably you could have seen that as a plausible response. Maybe just the fact they wanted to see a little bit more on labor force participation coming back. That seems to be the toggle. It's also, I have to, kind of emphasize, it's a global move in yield. So yes, obviously the U.S. the U.S. employment data matter a lot, but I'm not sure that that's the sole driving factor in the way we're repricing, the global bond market at the moment.
What's up with labor force participation, Michael Feroli? Because that makes it tougher for the Fed.
Yeah, it's tougher for the economy. I think it's really difficult to explain one month's move. I think that's kind of fruitless. But one thing I would say is that in general, over the past several months, participation has probably been doing a little better than we and most economists have expected. And so perhaps last month was just a little bit of give back on what had been a generally more favorable than expected outturn. But I think it's really difficult to say for exactly why April set back.
Really quickly, what do you expect for CPI next week?
CPI, I think, is going to be another firm one. We're still dotting the I's and crossing the T's on that one. But I think both the core and headlines should be pretty firm next week.
Yeah. Key consumer price data out next week. Michael Feroli, thank you very much from JPMorgan.